Compliance is a lot about risk.
What are the most tricky ones?
Keep throwing three-letter acronyms at things.
Hello everybody, I'm Masha.
And I'm Sania.
And this is ValueTokenized.
Today we're interviewing Matthew Unger, the CEO and co-founder of iComply, end-to-end solution for issuance and maintaining compliance on security and utility tokens.
So hi Matthew, thank you very much for joining us here at ValueTokenized for an interview. Maybe you can tell us some words about yourself. How did you join the whole blockchain party? What's your background?
Yeah, sure. I actually, how did I join the whole blockchain party? That's a very long story, but I guess I started my career as a broker-dealer in Canada. I was actually at the time the youngest licensed financial advisor in the country, and spent about 4 years, building a business that was supposed to be around helping people save money, around helping people invest in their life savings and have good value type investments available. After about 4.5 years, I built my business to $42 million and just found that I was not getting what I wanted out of the industry. I sold it to my business to the largest wealth management firm in the country, which is Investors Group, and tried to spend 2 years there working on what they called leading innovation. And somebody came up with a very good term and called it pushing dinosaurs. In a tier 1 financial institution, it can be very difficult to innovate sometimes. And you just, after about 2 years, I moved into enterprise tech consulting, which I've been doing over the last, 8 years now. A lot of different phases in financial technologies that I've worked with. I've worked for companies like BDC, Bank of Canada, secret level clearance with CSIS, which is Canada's CIA. I've done a number of different projects during kind of the robo-advisory trend and the equity crowdfunding, and then crowdfunding before that. So I've seen a lot of different trends, and one of the things that I really noticed was a lot of the barriers. Every time a fintech company tried to get off the ground, it was always so difficult to get the compliance in place, and oftentimes could cost millions of dollars just to get compliance together for 1 or 2 countries. And then the second that they try to move into a new market, they couldn't. And I think that's, for me, that was, a very pivotal piece. In 2014, I was working on a project. There was a new legislation in Canada in financial services called CRM2, which basically requires any broker-dealer, any fintech platform, any financial advisor has to keep very, very clear records in a very consistent way. And so that was involved in kind of this. And one of the changes that came with this legislation was e-signatures. This was the first time where I saw the move towards financial services actually allowing full signing of transactions and things like this. And it seemed very interesting. And it was working on that same project that I was working on, where we started to see a lot of maturation in a lot of the blockchain projects. The technology was becoming viable. There were proof of concepts with Visa, proof of concepts with major firms that were testing this out. So I actually really started to do a deep dive into the technology. I spent the better part of the next 2 years really going down the rabbit hole, so to speak. I actually worked on, I did a program out of MIT focused on financial technologies, blockchain being my main focus, blockchain and data sciences, and really looked at how could we use things like blockchain and artificial intelligence and layer in a much more structured financial services environment. It was my personal interest. We did a project there where we used smart contracts on Ethereum in 2016. Where we took, there was new legislation coming into effect called Basel III after the financial crisis in North America. And so we saw this opportunity there to really try testing smart contracts in this way. And what we found was that the cost of these smart contracts was, the cost of doing this with manual work and legal, typically paralegals sifting through documents, was $12,000 per transaction. Whereas in our proof of concept, we were able to demonstrate you could do it the same work with smart contracts for less than $1 of computation. And so for me, it was that was a proof of concept. These are very complex transactions. And I started to really get excited about how could we structure workflows that meet the compliance procedures of the firm, of the government, the regulations, and how do we build proper business workflows into some of our more traditional financial services transactions and really use this to disrupt that sector.
Can you tell maybe more about like compliance itself? Because there are a lot of people out there from crypto backgrounds not knowing much about like legal and financial structure. So like, can you give us like 101 compliance crash course? What are the main issues with it?
So compliance is a lot about risk. And so a lot of people think compliance is what the government tells you have to do, but it actually is significantly beyond that. So compliance could be as well things like if you want to serve in work in a certain industry, there might be industry standards that you have to adhere to. Financial services is definitely one of those. If you want to keep people's credit card data, there's a lot of standards around how you hold, and there's standards like PCI as an example that are there to hold you to a standard that's not regulated by the government. Your vendors or your customers might hold you to certain standards, your shareholders or investors might hold you to certain standards. And when you put all of this together, business risk, governance, and regulatory, that's where you end up really with what is more broadly called compliance. And so some of those things are things like the government says you have to do, like KYC and AML. But other things specifically in the area of security tokens, because I know that's a very a big part of what we work on, is the compliance in the trading of the tokens, making sure as they go through different jurisdictions that they actually follow the current regulations of that jurisdiction is actually a big part of what we see kind of missing in the space right now. What we're really focusing on doing is trying to provide very light and simple, easy to use tools, whether they're on-chain validation services or whether they're APIs that allow people to very easily implement a multinational banking compliance program. So if you think of just the regulatory side, not the business risk, not the governance side, not what your shareholders agreement says, but just the regulatory side, by the time you layer GDPR and KYC and AML and BSA compliance and keep throwing 3-letter acronyms at things and occasionally a 4-letter acronym, and then you have this massive web of compliance, it's very, very hard to find what is the proper path to take in any jurisdiction. And then some jurisdictions are easier, but then when it starts getting very, very complex when you layer more and more jurisdictions on top of this, what we see as the big opportunity really is having simple regulatory services. And that's really the only thing that we do as a company is just do that regulatory layer. So as an example, we have a database of accredited investors, of non-accredited investors, of offerings, exchanges that we all serve, security token platforms that we serve in different markets. But we don't connect investors to projects. We don't connect buy and sell sides on trades. We simply screen against those connections as they're made by exchanges that are operating with a license or a security token platform or a security token issuer who's putting information in front of their investors. So our focus is very much to just focus on that layer. It's very complex and there's a lot of moving parts to it. But what we find is that if we can use this same technology to automate this part of the workflow, this might be one of the most powerful advantages that crypto has over fiat markets. Is our assets are digital. They aren't digitized. And the difference between a security token and a digitized security is that that digitized security started off in a non-digital form. And you have no way of knowing if that PDF is for sure the true copy or not. But with a token, you know. And if you put your share certificate into a token form, you can track, it can self-report its regulation the entire time as it moves along. And that's, I think, where I've worked in this space. Most of our team has had some experience, in some aspect of financial services or compliance. And you see in Canada, the number of back office and mid office employees, just in my country here, 87,000 people ticking 3 or 4 checkboxes on forms of paper and then scanning a copy and shredding it. And so this is a major issue. 15% of any financial institution in North America and higher in other parts of the world is spent on compliance. So I think the key things to think about from fintech with compliance is it's about risk. So you're always going to have risk in your business, and you have to figure out how to manage that properly. First thing to not do is to buy, there's a lot of, I would say, eKYC platforms, and I'll probably call most of them snake oil, is there's a lot of ticking the box, like, oh, boom, there's a green checkbox, there was a KYC check. But how do you know that how did that KYC check apply to your company is actually a very different question. And that's the difference between complying with regulation and simply, ticking a box and hoping that it'll be okay. And so that's a big part of what our objective is as a company, is to really try to make it easy for companies to manage this in a fully digital workflow. The assets are digital. Why can't the workflows be digital? Why are we submitting? We met recently with one of the regulators in North America, where we sat down with them and he said, why do we have to submit paper or these email PDF SARs, suspicious activity reports? They said, well, we don't have any other system. We met with a securities regulator in North America and they said, we would like to report, but this industry, these trades are happening so quickly that if you use your current reporting systems, people are going to be filling in papers every 7 days. And they said, well, are you suggesting that the regulator would have an API? And we're like, that's exactly what we're suggesting. Like, you guys need a way to digest this digital information. So I think over time, we're going to see the regulators improve, and that's going to make compliance a lot easier. But in the meantime, tools like ours are a big leap forward from having to do things manually.
From all jurisdictions in general, what are the most tricky ones?
The most tricky, probably the ones that have the least experience would be more difficult, because the more issuances that happen in a jurisdiction, typically there's more legal resources available to support you. And that tends to be one of the biggest issues. So I don't think the US is necessarily tricky as much as the current regulation is quite ineffective at enabling innovation to get funding from anybody beyond accredited investors. In Canada, we have prospectus exemptions here that you can register your offering. So in the US, people are familiar with things like Reg D. But in jurisdictions like Canada, any company can, start their company in British Columbia online literally in a few hours, set up a corporation and issue a security in a matter of days, quite literally. And you can raise an unlimited amount of capital from an unlimited number of investors, accredited or non-accredited, in and outside of Canada. So it's kind of like combining a Reg D and a Reg S and getting the best of both. But then what you also have to keep in mind is no matter what jurisdiction you issue from, you have to abide by the regulations of where the investor is. And so you finding a good jurisdiction to issue from is a good piece. I see a lot of offerings issuing from the US, and they'll carve out, okay, we'll do a Reg D in the US and a Reg S outside the US, and we'll somehow split the tokens or issue separate tokens. I think these are getting really, really, really overly complex. And they're blocking all of this. It's like legacy corporate governance that they're putting into smart contracts. And so it's going to make those companies that take those approaches, it's going to make them much, much less competitive. Like we see with security tokens really taking off. We have projects live in almost every part of the world. And where we see a lot of traction right now, we see a lot of things moving in Europe and Asia a lot faster than North America. If you look at the number of ICOs that issued in 2017 and look at their investors, look at how many issued and how many were from the US. Over half are from the US. And a lot of the US VCs went in really hot and heavy into the ICO game and got really burnt. And I think the market here is still quite bearish compared to what we see the innovation happening in the industry and what we see the temperature in other parts of the world. So, when we met you guys in Asia, as an example, the value that your project is bringing to the market is palpable, right? Whereas you come into a place like North America and everyone's like, yeah, maybe in 3 to 5 years. They don't understand that the infrastructure, the smart contracts, everything has been built and tested and proven, and people simply weren't filing regulatory forms. So this next iteration, I think, will be a lot more. We'll see a huge amount of assets rushing to tokenization, but I think they're going to be a lot less trading. People aren't going to buy on speculation as much as I'd like to own $100 of my local coffee shop or $1,000 of my local brewery and get a 6-pack once a year for it. Stuff like that. I think we're going to see a massive amount of projects like that going live in the next 2-3 years. In next year already, we'll see some very interesting stuff. I know of one company. I don't want to do any spoilers for them, but they are one of the top 10 single malt whiskey manufacturers in the world. a very well-established business. They'll be tokenizing vintages of their whiskey that people can purchase ahead of time. So they are security tokens. They trade, but they are exchangeable for a bottle of whiskey when the product is ready. And it's a very interesting because it's a luxury good as it is, right? So I think there's a lot of, how awesome would it be to buy whiskey token for, for somebody for the Christmas as an example. There you go. You get this bottle of really fine whiskey, years before it's ready potentially. And so I think that we're going to see a lot of companies. The interesting thing is this company is raising non-dilutive capital, right? So they aren't having to, it's a family operated business. They're not having to necessarily sell off equity. They're not having to give up massive amounts of their company to pretty much the only alcohol supply chain provider in the world. So they can access their market in a very unique way, and it's a really established business. There's another company that we've been working with, publicly traded company, that's listing a security token. They're raising non-dilutive capital. They have an online platform, and the token will function in the platform, but the platform isn't ready for the token yet. So they're raising it as a security, and it'll actually trade on a tier 1 stock exchange until like the next 2 years of when the platform's ready. So we're seeing a lot of people try very different things right now. We've met with stock exchanges, we've met with crypto exchanges that have bought ATS licenses. People are trying different angles at it, but I think we're going to see there's going to be a couple of ways that are going to be winning in 2019 that are really going to become the rails of how things are done in the future.
So you have just mentioned 2 different types of companies. Real life company on one hand, whiskey, and on the other hand, online platform. So do you think security tokens work equally good for both, or no?
Security tokens in an online platform. So maybe I would read your question, I guess, or interpret your question to be more like, are we still going to see utility tokens? Because I think there's the security token can work in those environments, but there's definitely a lot of scenarios where a utility token just makes a lot more sense because it's actually there to fulfill a utilitarian function. And so it doesn't necessarily mean that it's when that function is worth a dollar value that there starts to, in my opinion, maybe it's not a security, but maybe it's a commodity, right? And so then you have commodities regulation to worry about. So I think that there's a lot of ways that they can be used. I think the most common way we're going to see initially, I think we're going to see a lot of small businesses. We see oil and gas companies tokenizing. We see supply chain companies tokenizing. We see a lot of different companies. In the case of, I'll give you one example. There's an oil and gas company that they actually use a blockchain to manage the supply chain of their carbon credits and different things like that. They're now looking at raising some additional capital for a new facility. And that additional capital they're looking at raising with a security token. Those tokens in no way interoperate with each other in any way. They're not even on the same blockchain or anything. So I think we'll see the technology applied in a lot of different ways. I think we're going to see a lot of online platforms having securities that perform functions, but then you'll also see things like gaming or CryptoKitties where your token is clearly not a security, and it's just simply, it is the actual asset. It's not a certificate for the asset.